Good evening, everyone. My name is Grace, and I'm the moderator for today's event. So first of all, a warm welcome from CAN UK committee to everyone for attending the second event of our March webinar series. This event will account for CPD. So if you'd like, please change your name to the format of name, short score, ARN number, and we will take screenshots of the attendee list for CPD records later. The topic for today is IFRS 17. We are so delighted to have two experts from Mazars to present the topic to us today. A bit introduction of the two speakers. So we've got Vitalina. She is the director within the UK Financial Services practice who leads Mazars UK IFRS 17 advisory team. Prior to joining Mazars, she was actively involved in the IFRS 17 standard setting process as a member of IASB technical staff. And we've also got Natalia. She's a senior manager in Mazars UK actuarial practice with over 19 years of practical insurance experience. At Mazars, she leads on provision of life insurance audit and advisory services. Today's webinar will cover several sessions, and there will be a Q&A session in the end. That said, we will also try to facilitate any burning questions that needs to be answered at the spot after each slide. So please feel free to post any questions you may have via the chat box throughout the whole session. And please also note, this whole session will be recorded and be posted to the CAN UK YouTube channel afterwards. Okay, I think that's enough from my side. Let's now hand over to Vitalina and Natalia.
Thank you very much, Grace. Good evening, everyone, or good afternoon, everyone. The structure will be, I will start first and Vitalina will pick up in the following slides from me. The theme of the presentation is IFRS 17 overview, and it is aimed mainly at the people who have recently started working with IFRS 17 or are learning the concept. We will talk through the standard purposes, what it changes, and the high-level principles throughout the slides, hopefully giving the key ideas, the key taste and sense of IFRS 17. You are welcome to ask more detailed questions within the Q&A session. And of course, if while we are talking through the slides, there is a very burning question which would prevent you understanding what we are talking about, please do ask it in the chat while we are speaking. Do not wait in that case until the Q&A session. The content of the presentation will be, so we'll cover briefly key aspects of IFRS 17, then the principles. The new standard is based on measurement, key principles of measurement of insurance and reinsurance contracts under IFRS 17. Then we'll outline the transitional options to IFRS 17, implementation timeline and challenges, key changes in IFRS 17 financial statements, and audit headlines, most important things within the audits and things for company management. So I will start with key IFRS 17 aspects. So IFRS 17 valuation of insurance business approach is based on the building blocks. The building block approach would probably be familiar for you from Solvency II principles. It's very similar in IFRS 17, where we start working with the first business building block, which would be the estimate estimates of future cash flows, IFRS 17 requires to take time value of money, to reflect time value of money. And this is where discounting building block comes into play. IFRS 17 requires to add risk adjustment, to calculate risk adjustments in evaluation, to adjust for risks insurance companies bearing when writing insurance business. And the last building block is the contractual service margin, which would reflect the profits the company is expected to earn from the contracts it writes, if contracts are profitable. So it took a long time to draft and set implementation timescale of IFRS 17. And over those years, the key aims of introduction of the new standard were to enhance comparability between companies' reports, considering time value of money was another key requirement and principle of the new standard, because time value of money has not been considered appropriately everywhere, which again made it more difficult to compare financial statements between market participants. The third and also very important aim of IFRS 17 was to ensure that insurance companies recognize profits emerging from contracts in line with the services provided under the contracts. Valuation of insurance contracts, especially life insurance contracts, can be complex, and life insurance contracts are lasting for years and years, and present value concept of future cash flows is used, and in certain cases for certain contracts, present value of future profits could be recognized under the current approach, current IFRS, in advance. And IFRS 17 aims to avoid it and align profit recognition not with the present value of expected future profits, but to align it with the services provided year on year. IFRS 17 also aims to focus more on current assumptions and be consistent with financial and not financial market. Separation of financial and not financial adjustments is also a key principle of IFRS 17 financial statements, and Vitalina will show you a couple of examples. Basically it aims for users of financial statements, enable users of financial statements to understand which adjustments and parts of profits have a reason from financial variables and which from non-financial variables. And hopefully IFRS 17 would bring to all of us more direct and transparent accounting and reporting. I mentioned that the building block approach in IFRS 17 is similar to Solvency II. And here I'm comparing Solvency II and IFRS 17 building blocks. So if in Solvency II, we would have best estimate of liabilities, which would be, in case of life contracts, already discounted cash flows where time value of money is reflected. In case of GI contracts, if this within up to 12 months, this will not be discounted, but still be best estimate of liabilities. Then we are adding risk margin, and by adding risk margin to best estimate of liabilities, we calculate Solvency II technical provisions, and whatever is left from the assets less the technical provision is to cover the solvency capital requirement, and own funds of an insurance company. A very similar approach is used in IFRS 17, where we would use expected future cash flows, then discounting to arrive at what in IFRS 17 called fulfillment cash flows, opposite to Solvency II technical provisions. Then risk margin is also part of fulfillment cash flows, and IFRS 17 is added to discounted present value of cash flows. And whatever is left, whatever difference is left from the present value of inflows plus risk margin and outflows forms contractual service margin in case the difference between inflows and outflows is positive. So briefly looking at the principles of forming these blocks, under Solvency II, valuation has more prescriptive approach. Solvency II's directive is very specific about how to value insurance business under the requirement, under the standard. IFRS 17 is much more principle based, where key aims are outlined, what should be done, and it's more up to insurers how they would do it. Risk margin in case of standard formula is also very prescriptive under Solvency II and calculated on net of reinsurance basis. IFRS 17 oppositely gives some principles and examples of methods that can be employed when calculating risk adjustment, but then does not oblige insurers to use these methods. And the risk adjustment for insurance contracts would be calculated on a gross of reinsurance basis, and reinsurance contracts would be valued separately and integrated into financial statements at a later stage. This is one of the key differences, that insurance and reinsurance business does not net off each other at an earlier stage, but reinsurance assets or liabilities are added on the IFRS 17 statements later. There will be differences between potential differences between cash flow projections for under Solvency II and under IFRS 17. There may be differences, for example, in investment expenses or in expense allocation to insurance contracts, but these are technical details that insurers address at the methodology drafting stage for each type of contracts. So in the next slide, I would like to show a brief comparison with the current IFRS 4 reporting standard for insurance contracts. If within life reporting under IFRS 4, we would have mathematical provision and provision for adverse deviation, which is like part of profit sharing and shadow profit account, and especially for with profits policies, funds for future appropriation. And under property and casualty insurance, we would have technical reserves and unearned premium as key blocks, key items. So these are all becoming much more similar under IFRS 17, where whether it's life or general insurance business, we would need to deal with expected future cash flows, whether these are over a year or in the case of general insurance business or over many years in case of life insurance business. So we're still looking at the future income and outgo. Same risk margin and contractual service margin concepts are employed. So saying this, so there is an approximation for general insurance contracts, or simplification as it is called in the standard. It is for short-term contracts, though it is still based on the same principles of building blocks of IFRS 17. Right. Solvency II and loss component. So I have not mentioned loss component in the earlier slides, but I said a couple of times that contractual service margin would exist if contracts that the insurer is writing are profitable, a group of contracts is profitable. So here I would like to show the difference between contractual service margin for profitable contracts and what we would call, what IFRS 17 standard calls loss component for onerous or loss-making contracts, and why they are different. The standard treats them differently. So if present value of cash inflows, which is in many cases only premium, in some cases it could be some investment rebates, but main cash inflow for insurers and the insurance contracts is premium received from policyholders. So if present value of premiums is larger than present value of outflows, and outflows would be mainly claims and expenses, outflows and risk adjustment, so present value of inflows is greater than present value of outflows and risk adjustment, the balancing item would be the contractual service margin, which would reflect the present value of profits a company expects to earn on this group of contracts. So this contractual service margin forms a new liability on IFRS 17 balance sheet, and it is a balance sheet item. It is a liability for the company, and this liability is released over time in line with the insurance services or insurance coverage, as it is called within the standard provided. So what happens if the contracts or group of contracts company has written is loss-making? It does not expect to generate profits for the company. Why company would write such contract is probably this is a question outside of the scope of this presentation, but sometimes it may happen, sometimes even inadvertently. So if the present value of inflows is less than the total of present value of outflows and risk adjustment the company needs to set up for this group of contracts, the difference is recognized as the loss component. And unlike CSM, the loss component is not a balance sheet item. It is an income statement item, and IFRS 17 requires to recognize loss components that has arisen on an income statement immediately within the reporting period where it has arisen. And this statement will be valid where the loss component is has arisen for new contracts that have been just written, and in that case it will be recognized in the contract's inception year, or if loss component has arisen due to adverse economic or non-economic movements that affected a group of contracts, if in any year of contract loss component has arisen, it will be recognized in that year. And even if contract was profitable before, CSM would be exhausted, loss component established and recognized for that contract. So the key differences between CSM and loss component: CSM is a balance sheet item, loss component is a P&L item and is expensed immediately. So in this slide, I would go through this CSM roll forward over a period, over a reporting period, explaining what items adjust the CSM and how it moves from the value it had in the start of reporting period to the value it would have at the end of the reporting period. Now, we start with a certain value of CSM at the beginning of the reporting period. We can think for simplicity that it is start of the year. IFRS 17 standard requires interest to be accreted on the CSM under the general measurement model. I need to say under the default model under which IFRS 17 standard operates. There are variations of this model where this interest accretion would be happening through other items, and this can be discussed within the question and answer session separately. First of all, we accrete interest on the CSM. Then we have this block changes to future cash flows. This block, it is a reduction in my example picture, but it can be a reduction or an increase. So this block is here to reflect a change in non-economic assumptions that would affect future cash flows. And if, for example, in case of life insurance, if we used certain assumptions to establish this CSM or to arrive at the CSM value at the beginning of the year, certain mortality assumptions say, and once we reach the end of the year, we have a different view to mortality assumptions. I don't know, for example, our current pandemic COVID happened, and we think that due to it being continuous, mortality rates would be slightly higher than we expected them to be in the beginning of the year. So we worsen our mortality assumptions, which make our outgoes to be slightly higher, and future net cash flows, income plus outgo, would be lower because we'll receive the same amount of income, but we expect now, due to higher mortality, high amount of outgo. So we adjust our future expected profit down by the present value of that change. Then at the end of the year, we would also reconsider risk adjustments that required for this group of contracts. And again, the adjustment can be either up or down. If we think that contracts for some reason have become more risky for the company to operate with, the risk adjustment can increase within the year. And if we can, risk adjustment related to future services, our view to risk adjustment related to future services can increase, and therefore the block would be going up rather than down. And one of the most important blocks, CSM release over the year. After all these adjustments, we need to release CSM over the year for this year. And the amount of this release will need to reflect amount of services provided under this group of contracts over the year. IFRS 17 again states principles of how to estimate the amount of services provided, but again, the specific approach would be designed by insurance companies when designing methodologies for individual contract groups. And adding all these items up, so we arrive to add the CSM at the end of period. Principles of movement within the loss component. Again, loss component, though expensed right away in the P&L, IFRS 17 standard requires it to be tracked at the back of the calculations. And if there are plausible changes for the company and loss that are large enough to exhaust the loss component, CSM can be reestablished for that group of insurance contracts. And this is the key why loss component and its movement requires to be tracked, that so after positive changes, potential positive changes, CSM can be reestablished. A bit more, I will talk a bit more about the risk adjustment now, and here I'm showing factors that impact the size of risk adjustment. So risk adjustment is an adjustment for, under IFRS 17, is the adjustment for uncertainty in amount and timing of cash flows an insurer would need to have under the contracts it writes. And while estimating those cash flows, so if the probability of cash flows happening is closer to a narrow distribution, if the distribution is narrower, high events happening under contracts can be high frequency but low severity or low amount of claims. Contracts of shorter duration, this gives a bit higher certainty to insure, and these factors would suggest lower risk adjustment compared to factors if we have very wide probability distribution or low frequency of events but high severity. I don't know, terror attacks or pandemics again happening, low frequency and can be very high severity. So it's very difficult for insurer to estimate when it would happen and how large the damage would be. And also longer duration of contracts. Longer contracts last, the more chance that changes would happen in economic or non-economic environment. And these factors suggest less certainty to insurers, and therefore insurers would require for this type of contracts higher risk adjustments than for contracts within the blocks you see on the left side, shorter duration, higher frequency on narrower probability distributions. So this is just for the feel of what features of contracts may impact risk adjustment. And a brief comparison of IFRS 17 risk adjustment with Solvency II risk margin. Yes, they are very similar and aim to reflect non-market, non-hedgeable risks. So if we start with the objectives, so under Solvency II, what we know that risk margin needs to reflect the amounts that insurer would require to take the obligation of a given insurance company, a given group of contracts. And the IFRS 17, as I mentioned in the previous slide, risk adjustment aims to reflect the uncertainty within the amount and timing of cash flows that arise for the insurer under that group of contract. Solvency II has prescriptive approach for risk margin calculation. It's either full calculation or potential modifications, allowable modifications as stated in the directive. For IFRS 17, no prescription of calculation technique. Again, the standard gives example, but it does not tie you to those examples of techniques to be used for risk adjustment calculation. The methodology of risk margin under Solvency II is based on the cost of capital. In IFRS 17, again, there are example of most common techniques, but no obligation to use them. here IFRS 17 measurement models. So the default measurement model under IFRS 17 is the general measurement model, which relates to very, very closely and directly to the building block we saw in the beginning of the presentation, building blocks, and under this general measurement model. So it assumed to be used for valuation of insurance contracts as a default. There are two variations offered within the standard: a premium allocation approach that can be used for either life or non-life contracts that are of duration of 12 months or less. It is a simplified approach where the concept of CSM and risk adjustment is simplified and not required for all parts of the valuation, as well as reflecting time value of money would be reflected not in all parts of the valuation of short-term contracts under IFRS 17. And another variation offered by the standard is a variable fee approach, which would be used for contracts with significant investment component, such as participating contracts in the UK market, or unit-linked or with profits contracts, if we think about particular business lines. There is a key difference between these modifications. That premium allocation approach is a choice of company, and company can use either general measurement model or premium allocation approach for short-term contracts. It's up to the insurer which model to use for short-term contracts. However, variable fee approach is a mandatory approach for participating products. So when selecting the valuation model, companies need to bear this in mind. Right, and in this slide, I will briefly talk about reinsurance contracts and difference for this under IFRS 17. So we can think of two types of reinsurance contracts when we talk about reinsurance. Reinsurance contracts issued, the most common case when a reinsurer issues a contract, signs a treaty with an insurer to reinsure their business. This will be a reinsurance contract issued and reinsurance contracts held. The reinsurance contracts held is the other side. If a reinsurer issued a contract, signed a treaty with an insurer, for reinsurer it will be reinsurance contract issued, and for insurer it will be a reinsurance contract held. So IFRS 17 states that when within the standards they refer to reinsurance contracts, they refer to reinsurance contract held, and differences from insurance business would be within reinsurance contracts held. Reinsurance contracts issued and the IFRS 17 are treated as insurance contracts purely because these are insurance contracts for reinsurers who sell them. Variable fee approach is not used under IFRS 17 for reinsurance contracts, but general measurement model and the simplification for short-term contracts of premium allocation approach can be used for both reinsurance contracts issued and reinsurance contracts held. There are further modifications for reinsurance contracts held, and the key of this would be that CSM for reinsurance contracts can be either positive or negative, which is unlike insurance contracts where a positive CSM can exist and be released over time. And if contract is loss-making, the CSM does not exist and the loss component is expensed through P&L immediately. So under insurance contracts, a insurance contract can be net loss or net gain, which would be either positive or negative CSM, which will be released over time as parts of profits or loss in line with reinsurance services received by the company. This standard requires assumptions used for reinsurance contracts by insurers to be consistent with the assumptions used for underlying insurance business. This does not mean that assumptions cannot be different, but difference needs to be understood. VFA model is not used for reinsurance contracts. Risk adjustment for reinsurance contracts held needs to reflect the amount of risks transferred under those contracts. And also the latest draft of IFRS 17 introduced an option of losses if underlying insurance business is loss-making and reinsurance that has been taken for that business is net gain profitable, the part of that net gain can offset part of the loss on the loss-making underlying business. So this is the recent modification of the standard, allows insurers to do it. Yeah, I think I'm over with my part, and I'm handing over to Vitalina to talk about more accounting matters of IFRS 17.
Thanks very much, Natalia. Really good insight. Good evening, everyone. So I'll try to be quick. I think I have around 15 or 20 minutes left. This slide quickly explains the transition approach to IFRS 17. The basic transition approach is full retrospective approach, and it is applying IFRS 17 as if the standard had always been applied. That means restatement of opening balances. Basically the requirement is to apply this approach unless it is impracticable. IFRS 17 doesn't say what is impracticable. However, we have the IS 8, which lays out when the standard, when retrospective application could be impracticable. Just interpreting the requirements of IS 8, I'd say there could be two most popular reasons of why full retrospective approach is actually impracticable for some companies, for some particular group of contracts. This is, for example, when the company simply doesn't have data, doesn't have the data in the required format, because all of us, even based on Natalia's recent presentation, realizes that there are various components of data which have not been captured previously under IFRS 4. The other potential reason of impracticability is the hindsight, the hindsight exists, for example, the transition date, when some assumptions can't be restored, can be replicated as of the inception date, as retrospective application would mean having all assumptions at the inception date. Say if the group of contracts starts incepted in 2015, if it's long-term business, then all the assumptions should be based at inception at 2015, and consequently all experience adjustment should be also considered up until transition date. So all this creates the complexity of full retrospective approach, and sometimes companies conclude that the full retrospective approach is impracticable. And in that case, the companies have a choice. This is a free choice between two approaches: modified retrospective approach or fair value approach. In practice, some companies assess various approaches, modified retrospective and fair value, and see what is the best outcome, see what is the CSM resulting from each of these approaches, and choose the approach based on that method. Some companies simply assess what they can do realistically and apply the fair value or modified retrospective approach, and more often fair value. So a brief overview of those two approaches. Modified retrospective approach is aiming to achieve the closest possible outcome to the full retrospective approach, and this purpose, this aim is achieved via various modifications, simplifications. I won't go into the details of simplifications, modifications, just highlight a few of those, such as using of actual cash flows instead of future fulfillment cash flows at inception date, which is a useful modification. It helps to use the practical expedient, and this information is often available. It's using some of the information at the inception, at the transition date instead of inception date, which is again making modified retrospective approach more sort of user-friendly compared to full retrospective approach. So what's the matter with the modified retrospective approach? Why some companies do not want to apply this? It's basically the fact that the modifications are rather prescriptive. So if the company does not have some of the data and does not have particularly reasonable and supportable information to apply a modified retrospective approach, it automatically fits into the fair value approach. So basically that means that the company cannot create its own modification or simplification. So the company can use modifications, but to the extent strictly prescribed by the standard. So moving to the fair value approach. Yeah, this is the residual approach. Basically, how this works. This works as the difference between fair value of group of contracts and IFRS 17 fulfillment cash flows at transition. So the key component that needs to be assessed here is the fair value of group of contracts. And this is assessed in accordance with IFRS 13 fair value standard. Again, the complexity companies face is that the methodology is not prescribed in IFRS 17, and IFRS 17 doesn't go obviously into those details. So the companies have IFRS 15 and they have to develop its own methodology assessment of what is the fair value of the group of contracts. Yeah, and basically the positive difference is CSM, negative difference would be recognized as the loss component, as Natalia was saying. I think what I actually didn't mention, jumping to all these three approaches, that those modifications are for the contractual service margin, right? So coming back to what Natalia was saying about the building block approach, all other components like fulfillment cash flows, they still apply as business as usual, because obviously there's a future cash flows and company has this information to calculate that particular piece of data at the transition date. So all these modifications are around contractual service margin. This is basically the most complicated bit of the building block approach and requires lots of assumption judgments and lots of historical data. And yeah, probably the key thing also to highlight that companies can choose transition approach based on a group of contracts. So it's not like, you know, all groups of fair value approach or all groups are full retrospective. There is this optionality which gives obviously good opportunity to apply the best approach. So that's that in terms of transition. The next slide highlights the timeline of IFRS 17, and well, that's it in terms of transition, but actually here there is also some information about transition. So I'll start probably with 2017, when the IFRS 17 was issued first time. Obviously, the standard has been developed over many years. Natalia told that. So it took, I think, over 20 years in total. So we forget about these milestones. We just start here with 2017. And after 2017, the stakeholders commented and had certain discussions around the standard, and in result of these discussions, the exposure draft was created, and there were certain targeted amendments to IFRS 17 that were issued in June 2020. So less than 1 year ago. The key principles of the standard, they remain the same as per the standard issued in May 2017. However, some points were addressed to make sure that the implementation process is smoother. So here we go. What we have now, we have the effective date of the standard, 1st of January 2023. So this is for the annual accounting period started on the 1st of January 2023. And that would mean that in the year 2024, the companies will publish the first accounts prepared under IFRS 17. So this will be the accounts for the year end 31st of December 2023. And here you can see on the slide a little square highlighting how these accounts will look like and what they would be comprised of. So there will be 3 transition balance sheets, and one transition balance sheet and two normal, basically restated balance sheets for the 31st of December 2022 and 1st of January 2022, and referring to 1st of January 2022, we say it is transition date. So whenever we talk about transition methodology and referring at the transition date, we mean now 1st of January 2022, and we all know that this date has been moved in a couple of times, so eventually it takes the effective date of 6/2. Yeah, and obviously there are 2 P&Ls, 2 cash flow statements, 2 statements of changes in equity and disclosure notes. So it's quite a hefty financial statement. I think that's it in terms of timeline. Obviously, there are milestones such as implementation plan, IT solutions, data preparation. That's what all companies are doing now. And we'll talk a little bit more about audit readiness in my last slide. So I suggest we'll just move on, conscious of time, and talk about the key implementation challenges. So I try to aggregate that and actually disaggregate the challenges into 3 types. So I call the first time is the challenges, the items that considered by the board during various discussions but remain unchanged. So this relates particularly to contracts that change their nature over time, risk mitigation option, contracts acquired in their settlement period. I think for the UK insurance, for the UK market, probably the key thing is about the contracts that change their nature over time. And that topic had quite a lot of comments, particularly from the UK companies. I'll try to highlight quickly the reason why the stakeholders were conscious about this comment. Contracts that change their nature over time, basically at the inception, they often meet the criteria of variable fee approach. However, for such contracts, when the option is exercised by the policyholder, the nature of the contract changes, and the contract can become more of an annuity kind of contract, which is more relevant to the general model approach. And having that, the companies face the fact that they have to apply variable fee approach at the inception, and whenever the option is exercised, they cannot change the model, because this doesn't meet the modification criteria. The model is selected once, and hence there is this concern that the model does not quite meet the nature of the contract after this option is exercised. So this is just one of the highlights. Well, another highlight was about the risk mitigation option. Many companies wanted to apply this retrospectively. However, the board decided that it will undermine the consistency and the basic principles. It will cause use of hindsight, which is prohibited, as we know. So this is one type. The other type are called technical complexities, time consuming. So I told you about transition. Again, things such as getting actual cash flows for the modified retrospective approach sometimes could be difficult. Developing IFRS 13 fair value methodology could be difficult. Obviously, the fact that modified retrospective approach is rather prescriptive is also quite challenging for companies, in terms of the companies want to have more estimates and more modifications. So this is the need to deal with these technical complexities. Another thing that actually I talked to Grace at some point recently the other week was the loss recovery component calculation, which is quite a challenge for reinsurance companies, for other companies. And again, this is a technical thing, and the amendment for loss recovery component was just recently made, and this amendment issued in June 2020. So that was actually in response to this stakeholders' comment that loss recovery component should be calculated at the inception to match the reinsurance contract with the insurance contract, to have this ability to recognize not only loss immediately for insurance contracts, but also the ability to recognize the gain. However, having this obviously causes complexities for the companies. Other areas, I put intentionally all the areas here, which is not very precise, but I must say that each and every company has its own technical challenges, and it's also very dependent on the jurisdiction. And just moving into jurisdiction topics, the annual cohort topic, which is widely discussed between European stakeholders. By saying European, I do not mean UK here. And this topic was lots of debate. This is for the context with multi-generational sharing. However, particularly for the UK insurers, at least that's what I've heard from the recent discussions, it wasn't the hot topic. So that's why it all very much dependent on jurisdictions. So this is the type 3. This is the type 3 of the complexities, some core principles of the standard, such as annual cohorts, which has not been changed because one of the reasons it has not been changed because it was one of the core principles to show the profitability of each group of contracts. So other examples were comments about the discount rates and some disagreements with having locked in discount rate and some mismatches, the current discount rate, and also more generic comments about the volatility arising due to economic or accounting mismatches. And I'll talk about that a little bit more, I think, on my last slide. So this is the overarching picture of complexities. But I think the best approach, if someone wants really to have like a more detailed understanding of complexities, just to literally dive into the comment letters of like each jurisdiction, and obviously see what's going on in the market, and what are the technical challenges. So moving on to the next slide. I'll briefly talk, just have, I think, a couple of minutes. I'll briefly talk about the new financial statements and new disclosures. What we have in result of IFRS 17, we have obviously new balance sheet, new P&L, and I'll talk more in my next slides about that. We have the footnotes disclosures, which again are quite hefty, and they new. They I think again more to a certain extent they're more difficult compared to what disclosures used to be in the IFRS 4. So if we combine this into 3 groups, those groups will be amounts recognized in the financial statements, significant judgments and changes in those judgments, and nature and extent of risks that arise from insurance contracts. And you can see this arrow, which basically specifies types of disclosures. And this is reconciliation of movements in LRC, LAC. This is the reconciliations of measurement components, including these building blocks components that Natalia described, future fulfillment, cash flows, risk adjustments, CSM, analysis of revenue, certain disclosures for assets for insurance acquisition cash flows, which are more detailed compared to what it used to be for the deferred acquisition cash flows, and more detailed requirements for the impairment test, and obviously disclosures on amounts recognized on transitions, which are also quite basically big and complicated. I think let's move on to the next slide and just show the financial statements, primary financial statements forms. So quickly about balance sheet. Balance sheet, as you can see, it becomes from the first slide less complicated. So you can see that lots of lines that used to be in the IFRS 4, they all basically shrinked, and now you have 4 lines: insurance contract assets, reinsurance contract assets, insurance contract liabilities, reinsurance contract liabilities. So obviously, normally for insurance contract, you will have liabilities. For reinsurance contract, always, also not always, often have reinsurance contract assets, but this could vary. So that's why we have these 4 lines here. And then the next slide highlights a little bit. Natasha, the next one. Yes, thank you. So the next slide highlights a little bit what is it sitting in this liability, for example. I mean, this is equally applies to other lines, such as liability as one of the examples. So here you go, you can see our building block approach. Again, Natalia told us about that. Is basically sitting here in the insurance contract liability line. So you can see the net present value of the future fulfillment cash flows, the risk adjustment, and the CSM at inception. And you can also see that particularly at inception, as I think Natalia also mentioned, that basically the way how the balance sheet and P&L is structured, there is no day one revenue, then day one income recognized at inception. And then you can see that this keeps evolving, and this is the evolvement of liability, which keeps decreasing obviously over the term of the insurance services provided over the coverage unit. So that's that. And the other thing, just to mention quickly, is the portfolio level presentation. So all this insurance contracts liabilities, reinsurance contract assets, they're all grouped at the portfolio level. So this is the level up compared to the groups. So you've got groups of contracts, and portfolio combines the groups. Just again to bear in mind that in the portfolio of for example, insurance contract liabilities in the current amount of the portfolio, there will be the asset for insurance acquisition cash flows also sitting here. So it is also sitting in this line, insurance contract liabilities, in terms of the presentation. However, in disclosure notes, you will see all these items presented separately in a very much very detailed level. I think the next slide is about P&L. Here you go. So the P&L, the biggest change to P&L is that we will no longer see the gross written premium line. There will be a line insurance revenue, and I'll talk the next slide how this is comprised. However, it's not quite the same what we used to see normally in the P&L on the IFRS 4. And just to highlight quickly, this is one of the, I think, reasons why some companies need to reconsider the key performance indicators, because often key performance indicators are based on gross written premium, but this is the off topic outside of this particular presentation. So here you go, our IFRS 17 P&L also slightly shrinking, having insurance revenue, insurance service expenses, net expenses from reinsurance contracts, and all these three lines comprise insurance service result. This is the improvement having this insurance service result explicit. Not all the companies having this now, so this allows to again have more detailed understanding of the performance of particular insurance part of the business. And then you can see that underneath this insurance service result there is net finance expenses or income from insurance contracts, reinsurance contracts. And again, this is the example of P&L, and there are several accounting policy choices for the P&L in particular. So the P&L might look a little bit different, particularly for reinsurance contracts. There could be two separate lines showing income and expenses separately. In my example here on the slide, it is net expenses. So this is the choice, and also various choices for the disaggregation of insurance finance income and expenses and disaggregation of risk adjustment between insurance service results and insurance finance income and expenses. And then just quickly to show how the insurance revenue and insurance service result look like on the next slide. There you go. So we can see what insurance revenue is comprised of. It's comprised of the release of the contractual service margin based on coverage units, the change in the risk adjustments, and claims and other insurance services expenses, and amortization of insurance acquisition cash flows. And you can see here also insurance services expenses, which again, the claims and other insurance service expenses and amortization of insurance acquisition cash flows. So this is coming through these two lines. And well, in this example, it's zero, but insurance service expenses also include losses and onerous groups of contracts and reversals and past service changes. For example, future fulfillment cash flows changes that relate to liability for incurred claims. So that's the overlook of the P&L. And again, conscious of time, so just to move to the next slide. And then the last slide is talking about the readiness, audit readiness to IFRS 17. Obviously, each and every company is preparing in its own way. I know that some jurisdictions have very thorough approach and require companies to submit implementation plan to the regulator, and obviously those companies are the advanced stage already. So what's the key, I think, here for the UK insurers? Obviously, the local endorsement considerations is the key. We'll need to monitor what's going on with the FRC endorsement. Obviously, your endorsement is almost there now, almost finalized, and this is important as we need to see whether the standard endorsed eventually in the UK will be the same as the one that is issued by the ISB, or there will be any carve-ins and carve-out. So let's see where it's going. Then obviously IT systems and all this gap analysis is a crucial thing. And thinking from the audit perspective, I'd say that important thing here is to make sure all the IT decisions, solutions are negotiated with the auditors, especially when it comes to certain simplifications, shortcuts. Sometimes they're required by the IT solutions. I think it's also important to make sure it's agreed with the auditors. Then again, the big chunk of it is the methodology and accounting policy readiness. I provided a couple of the examples where we know that the standard does not provide a very detailed methodology. Another example of this is like risk adjustment, when there are overarching principles, but methodology is not so detailed. So companies need to spell it out, need to make sure that robust accounting policy exists. And obviously they need to make sure that auditors are comfortable with the methodology and principles they use. Then solutions for areas of complexity, talked a lot about that during our presentation. So again, just to highlight, UK insurers focus with profit contracts, contracts that change their nature over time, and this P&L volatility questions, particularly resulting from the interaction of IFRS 17 with other standards like IFRS 9 and the new standard, the new primary financial statement standard, which is yet to be issued. It's been at the exposure draft stage, so I think it's yet to be finalized relatively soon. Can't comment on the timeline. So moving next to the next sector of the circle, this is transition. So we talked a lot about transition. Obviously, for audit, the key is to make sure that the opening balance sheets or restated balance sheets are audited appropriately. Transition is often done in the Excel tools rather than systems, so it's often outside of the system exercise. So needs to make sure that auditors have sufficient comfort over the transition balances and data that contributes to this transition calculations. And again, the last, but not the least sector on this slide is knowledge sharing. And I mean, it's probably not about the audit, well, but also about the audit, because if you think about all the judgments, all the significant estimates, it's eventually something that management is signing off, and management is taking responsibility for. So this is the key thing, to make sure that all the top level understands the basics, understands some complexities, and that the knowledge about the standard is relied from people like you, actuarial experts who know all the complexities, all the difficulties, and streamlined as much as possible to the people who sign off the accounts. I think that's it from my side, and please ask your questions and comments.
Yeah, thank you very much, Vitalia and Natalia. It was such a great presentation, and it's very insightful, and it's a good overview to the topic for everyone who's interested to the topic. So I'm also conscious of time, but I can see there are already a couple of questions in the chat box. Are you happy to maybe quickly talk about them? Yeah, so
Absolutely.
Okay, great. So the first question is, so is there any guidance on how discounting curve is set? And then the second question, yeah, sorry. Yeah, go ahead.
There are principles within the standard which should be used to derive discount rate curves, and two approaches are given as top-down and bottom-up. But again, despite all the principles given, they are still principles, and a lot of judgment and decision-making from companies would be required to derive their own discount rates for those particular groups of contracts. But yes, overarching principles are given within the standard, within the discount rate section, and within the appendices as well.
Yeah, thank you very much for that, Natalia. And the second question is, if loss component is recognized at the beginning of the period and then turns into CSM later, can CSM be recognized as a balance sheet item at the end of the period?
Yeah, for both loss component, if we are talking about the end of period when the contracts come off the books. So the principles of IFRS 17 require you to exhaust the CSM, release all the CSM, or they exhaust the loss component, run down the loss component to zero by the time the coverage period ends. However, if we are in a scenario when loss component was recognized in year one, say, and then there were plausible changes affecting the estimates of contracts cash flows that exhausted the loss component, and a CSM was established for that group of contracts, and a new balance sheet item as a CSM appeared. So that newly established CSM will still need to be exhausted by the time the coverage period for those contracts ends. The principle is the other way around as well. If contracts were profitable, changes happened, and contracts became loss-making, loss component was recognized. That loss component at the back as a back shadow item needs to be run down to zero by the time of coverage period ends.
Okay, is there anything you want to add from your side, Vitalina?
No, I completely agree with what Natalia is saying. I mean, yeah, we can't have that CSM recognized at the end of the contract. The principle of CSM, just to remind briefly, is unearned profit. So you have to exhausted by the end of the coverage unit.
Yeah, so it will release over the period eventually. Yeah. Yeah, that's good. So I guess we can then say it's the end of the presentation then. Thank you very much to you both, and thanks for all the attendees, for everybody. Please bear in mind, we will upload this video to our Can UK YouTube channel later, and also watch out for that. Okay, so thank you very much again, and have a nice evening then.